as a format, we'll go with a presentation first, and I will start the corporate presentation now. So thank you all for making the time. And with that, Nigel, maybe you can just start the brief introduction. Thank you. So Prime US REIT listed in the middle of 2019, July 2019. So we've been listed for nearly 4 years now. The portfolio was originally listed with 11 properties, about $1.2 billion in valuation. And in essentially the assets that were injected into the portfolio at IPO was spread across a number of different markets across the US. And there's the thematic associated with these assets where they were in non-gateway cities, relatively speaking, high growth cities with great affordability, educated workforce to help, employers find and attract educated talent to their teams, high employment growth, good infrastructure, low density, so nice places to live, and in good urban environments. We have subsequently done 2 sets of acquisitions. One acquisition was done in February 2020, where we raised $120 million from a private placement, and that was to acquire Park Tower in Sacramento. And if you look at the map, it's the highest of the 3 stars on the left of the screen, on the left of the image, in Northern California. It's the capital of California, the political capital. In 2021, as we were looking at our growth plans and so on, we had a credit facility from a number of US banks that had been put together by Bank of America. We upsized that facility to $600 million, about $130 million increase. And then we also raised $80 million in a private placement to acquire 2 assets, one of which was Sorrento Towers, and that's at the bottom of California on the map here on the left edge of the map. And then the right bottom edge, we bought One Town Center, which is in Boca Raton, Florida. So this was a total of just under $250 million of acquisitions funded by the upsized credit facility, partly, but really 2 specific loans that we put in place for these 2 acquisitions. So that brings us to a total portfolio of 14 assets, 11 at IPO, 3 acquired. We've had 2 capital raises associated with those acquisitions that brought new equity into the market. All the acquisitions were accretive, and post the acquisitions, we maintained our leverage at below 40%. We were included into the FTSE EPRA REIT index in September 21 as a consequence of the capital raises we had done, as well as developments at the EPRA REIT index metrics that they look at. And then the big landmark for us in 22 is we consolidated our property management services with a very substantial real estate company in the US, Lincoln Property Company, who brought a number of developments to our portfolio. Most notably, they look after and manage a number of our ESG efforts. So with that, I can turn you to the, so that's where we are. So we've got 1.54 billion AUM right now. And with that, I'll just turn you to the next page to talk a little bit about where we stand today. So, as we ended the first quarter of 2023, we have a Class A portfolio. As I mentioned, the assets and what some of the key attributes were to those to the cities that we are located in. We've got very high quality. They're all Class A assets, and in this environment where there's flight to quality as tenants are looking to be located in high quality buildings in an effort to bring their tenants back and their employees back to the office, we benefit from that flight to quality. They're well located assets and very well diversified. The return to office is continuing to improve. It's still uneven across markets. I'll talk about that in a little bit. One of the key things that a lot of people think about now in the current environment is really around financial strength, financial flexibility, what's been happening in the context of rising rates, what's happening in terms of, leverage, and in the context of what's going on in the US office market. So first up, I would say that our leverage is about 43.7% as of the first quarter. A lot of this is timing differences. It's probably between 42 and 43% on a steady state basis. At this point, we had drawn down on our revolver to pay out distributions literally on the 31st of March. So there's some timing difference associated with that. But even at that level, we have undrawn and available facilities of over $165 million. We are well supported by well-established banks and financial institutions in the US. Obviously, we've got refinancing that we need to think about in 2024, and I'll talk about that in a little bit. What's really important we've been prudent in terms of our capital management. So we have 79% of our debt is either fixed rate or hedged, which has buffered us against the very steep rise in interest rates that we've seen in the last several months. And that has helped, protect to some degree our distributable income. The interest coverage ratio is very healthy at 3.8 times. So I think the best way to describe how we have performed over the last, call it 6 to 12 months is continued resilience. Our occupancy is in the high 80s, and it has been in that range now for a few quarters. Prospective tenants are continuing to show interest. We've got ongoing tours. We've got positive rental reversion that has been in place now for a long time. And we've been demonstrating rental reversion for many quarters consecutively. Our WALE is just under 4 years, and it's been around this level now for the past, kind of year or so. Turn to the following slide. So over the course of the first quarter of 23, we came out as well with our financial update. Net property income, 23.6 million, down from first quarter of 25.4. So when we look at the distributable income, there is about a $4.3 million difference in distributable income on a like-for-like basis between first quarter 22 and first quarter 23. There are a few reasons for this, but first, maybe I'll just start by saying that for a number of reasons, but certainly given where the stock price is trading now, and in order to limit dilution for existing unit holders, we made the election for 2023 to pay the entire management fees in cash and not to issue them in the form of units to the extent of 80%, which was the case earlier. So we've shown from a demonstrable basis what the distributable income would have been on a like-for-like basis had it been 100%, last year, just to show a frame of comparison. And then the lower in gray is just to show what it would have been in the first quarter of 23 had we not changed our base fee format. So when you look at it from a like-to-like basis, $4.3 million, assuming 100% of the management fees in cash, and we've laid out what are the key differences. Number one, finance expenses, primarily due to higher rates on the unhedged debt. We did have some lease income, lease termination income, that had been contributing positively to distributable income in the first quarter of last year, and that was absent now. That amortization of lease income has been exhausted by the end of last year. There have been some higher property expenses, and a lot of that has to do with employees' increased return to work, as well as a lower gross revenue, and that has to do with some occupancy declines. So one of the things I would just say is that on a quarter-on-quarter basis between the fourth quarter of 2022 and the first quarter of 23, there's been, relatively speaking, stable in terms of the distributable income. To the following slide, just to talk a little bit about the debt summary. I think there are a few headlines here. About $700 million of drawn debt. I talked about the leverage ratio. I think the important headlines here, $200 million of debt headroom up to 50%, which is our covenants as well as the MA's guidelines. Significant liquidity, which I think is very important in this market as we look to spend money on amenitizing our buildings and supporting our lease efforts through tenant incentive packages. Our weighted and effective interest rates are still sub 4%, healthy interest coverage ratio, and a weighted average lease maturity of 1.7 years in absolute terms, 2.5 years on a fully extended basis. I'll talk about that on the following page. What I would just say is that the extensions that we need to put into place for 2023 expiring debt, that process is currently underway. So I turn to the following slide. I think this is an important slide and we are starting with credit facilities, given how much noise and so on there is being recently around rising rates and, what does this, what does the current environment mean in terms of immediate refinancing? So this is just to show you what our credit facilities look like. And really, I categorize them into three broad buckets. One is our main credit facility. It was led by Bank of America. It's essentially is an unencumbered, there's an unencumbered 11 assets. And against that, we've got this credit facility. The total facility is $600 million, of which about $440 million is drawn. Two term loans of $200 million each, aggregating $400 million, and a revolver of $200 million. So that's the total $600 million. We have one of the term loans, and the revolver has an initial maturity date of July 2023, but with extension options available at our option to extend them till July 24. And as I mentioned earlier, these extension processes currently underway in documentation with the banks. We then have another credit facility, secured facility from MetLife. It's a term loan, $105 million. It secures one of our assets, the one in Salt Lake City. It's got a maturity of 2029. And then we took two financings for the acquisitions that I just mentioned earlier, for the acquisitions in San Diego and Boca Raton. And these were structured as term loans and revolvers. And the way they were put in place was they have an initial maturity of July 2024 with extension options, 2 one-year extension options taking us to July 26. So as you'll see, the way we've looked to structure, other than the fixed term loan taken from MetLife, we've looked to put into place facilities that have shorter maturities initially with extension options. The extension options are very on base of very small fees. 10 basis points is what we need to pay to extend them. And as long as we maintain our covenants and our reps and warranties, that extension is at our option. We already extended the revolver, the Bank of America revolver of $200 million. It had its first maturity in July 22. We extended it to 23. Now we are in the pit, so extending it to 24. So that's what our debt stack looks like. So if you look at the debt maturity profile, if you look at the top right side of the page, you will see that we've got $439 million with an extended maturity out to 2024. We've got the two facilities from Citizens, which are due in 2026, and then we've got the MetLife in 29. The other thing I'd make a point on is hedging. We've got significant amount of our debt already hedged. In fact, $550 million have hedges associated with them. So if you look at the bottom right side, you will see the Citizens loans are hedged through till 2024. $330 million of the Bank of America credit facility has got hedges on the benchmark on SOFR all the way till 2026. So that goes even beyond the maturity of the loan itself. And these swaps are well in the money given where the rates are right now. And finally, the 15% or $105 million is fixed. That's a fixed term loan with fixed pricing on it from MetLife. So turn to the following page. So this is another graphic way of looking at it. 79% of our debt is hedged through to 2024, and 62% of our debt is hedged till 2026. And then the final 15% is fixed through to 2029. And we like to give this disclosure to investors for people to understand that we've got actually a very solid, kind of hedging profile in place that protects us to a great degree, not just in terms of percentage of debt hedged, but also how long it is hedged, which is really important in an environment where rates have gone up, and we are watching constantly when the rates will the rates will first pause and then start to come off. Turn to the following slide. So I'll talk a little bit about our portfolio. As you will see, we've got about low to mid-teens of our portfolio expiring in each of these coming 3 years. So leasing is obviously a very important priority for us. In fact, the most important priority. The first quarter, we saw leasing of about 64,000 square feet. It was a bit lower than we've seen in a lot of previous years. It was a low quarter, but then we've actually as well mentioned here that we had about 38,000 square feet, just under 38,000 square feet, also executed in April itself. So, we did see a pickup in some leasing, and, sometimes leasing can be a little bit lumpy. So if you get a large lease or a large amount of space, it can certainly increase the overall leasing volume. We have had a very, very good track record of positive rental reversions. In fact, we've had them for several consecutive quarters for nearly 3 years worth of rental reversions positive. This time in the first quarter, we had a negative rental reversion, and it was impacted by two transactions, two leases that had very, very low TIs. So, tenant incentive packages and, a part and parcel of the leasing conversation. And we were, in this instance, looking at what was a net effective rental reversion, which were actually very positive. And so while the headline rent was negative, the net effective rent reversion was positive, given the fact that we didn't have to put out large TI packages associated with those leases. If I can turn to the following slide. So this talks about the rental reversion potential in our assets. And what we look at over here is the annual in-place rent versus what is the asking rent to assess whether there's a rental reversion, positive rental reversion potential. And what I would say is, for the large part, with a couple of exceptions, there is positive rental reversion potential in our buildings. And what I would say as well, the other takeaway is that, so therefore our key priorities are going to be those assets that have lower occupancy. So one Washingtonian is one asset that we're going to be focused on. It's got a large tenant that is expiring in December 23 and will be vacating. So we need to actually spend some time and effort on that building next year. Not just leasing, but it's been very much dedicated towards Sodexo to make it more suitable for more multi-tenant occupancy. So there will be an amenitization exercise on that building next year. Reston Square has low occupancy. You'd see that the bottom asset here, it's a very small percentage of asset value, but this was largely on account of one tenant that was acquired by another entity and therefore vacated the space. And so we are amenitizing that building, but also amping up the leasing effort there. Tower 1 Emeryville, which is our asset in the San Francisco Bay Area in California. So that is just about 70% occupied. And that relatively quieter market, a relatively low, slow return to work. And then Village Center Station 1, which is one of our two assets in Denver, where we are, the other asset is 100% occupied by one tenant. Village Center Station is multi-tenanted. We've got some active leasing conversations going there. So those are our priorities. But if you actually look in a number of the other assets that are very well leased, in the mid 90% range, there are a few others, which we will be looking at. Park Tower, where we've got some interesting leasing conversations going on. Tower 909, we've got interesting leasing conversations where we've got tenants that have expressed interest in expanding in the building. Promenade, which is in San Antonio, Texas, is a good market and a great asset. And this is where we are. We had one tenant that vacated, a big F&B tenant that vacated last year to go to lower cost premises. And we are in the midst of leasing that space up. So ongoing leasing activities and leasing discussions are quite active across a number of the assets. These are the four assets that we will focus on. I think the other thing we would say is that, and I would say is that there are a couple of assets here that are 100% occupied, and we expect they could be, got a path to full occupancy on two more. But what we are really focused on as well right now is making sure we get the right leasing outcomes. We are not necessarily focused on headline rents. We are quite happy to consider deals with lower headline rents, with lower lease concessions. After all, leasing concessions are funded from our balance sheet. So, we are quite happy if tenants are willing to look at lower TI deals for lower rent. But we will be focused on net effective rent economics And we've been disciplined on that all the way and expect to continue to be. Following slide. So if you look at the sub-market outlook, I mean, generally what I would say is a couple of things. One is for a significant, number of our properties, our occupancy is higher than the sub-market average. That's really one key takeaway I'd have on this page. I think the other takeaway I would say is that the projected rent outlook for a number of our properties continues to remain positive. There are two of these where there's negative outlook is, as I mentioned, the two assets in Washington, D.C. While the headlines for Salt Lake City, which is the first asset here, and Pennsylvania Cross Point, which is halfway down the page, what I would just say on both those assets is that there's been tremendous leasing momentum. And at least for our building, we've had some great leasing outcomes, including from a rental reversion standpoint. And I would say probably the same thing applies to our asset, the third from the bottom in St. Louis Clayton. Those are assets. While the market projected rental growth has been negative, we've been seeing positive rental reversion, certainly for our assets in those markets. The following slide. So we do have, if you look at our top 10 tenants here, it's a good mix of tenants with, from the financial services, oil and gas, legal, large and reputable legal firms, medical, food services, communication. So very well diversified. And as you look at our portfolio as well, on the left side of the page, you would see that it's pretty well diversified, and certainly not in the sectors that have been announcing large job cuts in recent times. So they're pretty established and growth sectors. And we feel pretty comfortable around the sector diversification, which adds to the resiliency of our portfolio. On the following slide, what's the current market environment? Well, the US market has made the headlines for a long time. First high inflation, then the rate increases. Then the question as to whether the rate increases will cause a recession. When will when will inflation get tamed? When will the market, or when will the Fed start to relook at rates, and what is happening with unemployment? And actually, when you look at this, unemployment has continued to remain low. There have been recent bank failures over capital availability and tightening credit. Inflation has come down. And the market is continuing to look at where inflation is to assess where and when the Fed starts pausing from what has been the most aggressive rate hike in over 40 years. I think the general view is that in the event, rates, peak towards the middle of this year, and then, at some point start coming down, it will be beneficial for office occupiers and investors. So we are obviously watching that very closely. Past rate cycles have typically been a brief plateau, and then some easing, but we'll wait to see where it is in this cycle. So what does that mean on the following slide? What has that meant for office trends? Well, there've been a number of, aside from what's going on the economy, and questions around where the US economy is heading, there has also been a unique dynamic associated with return to office in the US in particular. Markets like Singapore, people came back to office a while ago. But as we look at office, trends in the US, return to office, as I mentioned earlier, has been quite bifurcated. There have been some markets that have been pretty rapidly coming back to work, and 60, 70, 80% physical return to office. But there are others that are still, in the 25 to 35% range. And so when you look at our portfolio, its occupancy, physical occupancy is in the mid-50s. So in this environment where employers are trying to get employees back to work, flight to quality is something that tenants have been looking at. We benefit from that to some degree, as we are high quality, well amenitized, well located assets. So we are an upgrade for tenants that aren't in those types of buildings. Likewise, there are brand new buildings that have got delivered in recent times, and for some tenants, they would choose to upgrade to those. So flight to quality is certainly something that is underway. And from our standpoint, what we started looking at as of last year was around amenitization of our assets as well as ESG initiatives, both of which are important for tenants as they think about return to office and getting employees back and attracting employees back to work. The leasing market has remained active in the first quarter, though it was lower 10%, over 10% quarter on quarter. And, we are watching that to see where that goes, because we've had quarters where leasing has been very good, and in others that it's been relatively speaking quiet. So that's something that we are continuing to watch. Rent growth has continued to be positive, and lease incentives and has been something that has been on a slight uptrend. So that's in the form of the dollars that you give for fit outs and build outs, as well as the number of months of free rent that have inched up a bit over the last few months over the pandemic period. Move-in ready space has also been increasingly attractive, and particularly it's in the smaller tenant space. Call it 3 to 8 or 9,000 square feet, not much bigger than that, because beyond that, they like to get involved with planning their space specific to their needs and so on. We've been very careful about building out move-in ready space in anticipation of tenants coming into the space, i.e. absent a lease attached to it. So that's something that we will be careful about. We continue to look for signs that there's good leasing momentum and interest in our markets for those size of tenants before we'll put in some capex, so that we can be sensible around when and how that capital is invested, but at the same time getting in tenants who are interested in that kind of space. The other development that I'm sure is quite expected in cyclical markets. Obviously we've seen some alteration in the demand supply dynamic in recent months for US office, and so development has slowed very sharply. New construction, not unexpected, has slowed down a lot, but also, as it has slowed down in recent quarters, deliveries of new office is also slowing down, and that is a welcome development for office owners, certainly for the medium to medium term. So in that environment, Nigel, turn to the next slide. What are our focus areas? Our focus areas are really amenitizing our building. What brings back people to the office is people and the opportunity to interact with peers, with people from other departments, the ability to collaborate, to actually be there in front of your superiors as well, and to make sure they're aware of what you're doing. All of those things are important. And so from our standpoint, and of course, there's been a big big focus on wellness, particularly, after the pandemic, both physical and mental wellness. So the kinds of things that, amenities that promote well-being, fitness centers, health clinics, educational programs, all of those things, not just physical spaces, but, the software around them as well. Creating spaces that encourage movement and interaction, indoor air quality to ensure that people feel safe, F&B options. So as we look at these, it's either, providing for an amenity, subsidizing or supporting a cafe as a building amenity in our assets. In some cases, we've been able to attract and have, high quality F&B establishments in our buildings. So the Capitol Grille in South Handley has been around for a long time. It's a great asset in the building. Means there's footfall and people coming into the building. But we've done that more recently as a new development in our asset in Florida. We've had upgrading of our fitness centers. In some cases, we've got one asset where we are building out a fitness center, common areas, upgrades, tenant lounges, and so on. So people who are in the workspace feel that they can go to these collaborative areas if they want to break outside office, lobbies. Activating those outdoor spaces are key things that we are investing money in insensibly. So the total capex that we are looking to spend across a lot of these, certainly for 2023, was just about in the little over 1% range in terms of across the entire portfolio. So we're being sensible on how we spend our money here. The next slide, Nigel. Yeah, so one of the examples of this is an amenity in Reston Square, which is an asset that does have, as we pointed out earlier, a key tenant that left. This is in the process of being delivered, in fact, any day now. And as you can see, it's got very high quality, conference rooms, dining area and lounge, kitchenette area, tenant lounge, so that, this is a space that we believe will be, tenants will find very useful, tenant employees will use, and will certainly be something that can help in the leasing effort. We are prioritizing a lot of our capital expenditure on those assets that have vacancy or have upcoming leases or leases coming up for vacancy. To the next slide. So I mentioned, for our Florida asset, we've got some dining options. We've got, the Red Pine restaurant. We've got tea and coffee, which has proven to be very, very successful. And so these are the kinds of initiatives that we are looking at constantly in our assets. We've got a couple of other initiatives. We've got a terrific F&B tenant in our asset in Sacramento that's in the process of being built out. So those are the kinds of things we're doing to make sure that our assets are well positioned in the return to office dynamic that we are seeing now in the US. To the following slide. Part of the exercise is also community events. I talked about ESG. The social element is really important. So to have events in the building that involve, tenant employees, we think is really important. And for them to get the feeling of community. So we've got a number of, these are just a sampling of events, but we've got a calendar of events across the portfolio right through the year. Lincoln Properties, and we put that together to ensure that we've got enough engagement and enough activity that tenants feel that we are an engaged landlord and that we are doing things to make sure that we can promote the social interaction. So our key management priorities, I think it starts with really leasing, and a lot of what we're doing around it is really around the leasing as well. So it is really our top priority. Enhancement of our assets and the amenitization is very much part of that. ESG, which we laid out on the right side, is part of that. There's the energy element of it. Tenants are looking at their carbon footprints. They want to know that they are in a responsible asset. They can measure their and also manage their energy energy usage as well as their environmental footprint. The social element, as I talked about, fitness center, wellness rooms, EV charging stations, outdoor amenities, community engagement, as I talked about. Technology solutions is something we are looking at as well, again, from a social standpoint, to try and assess what other platforms we could use to improve the usage experience for tenants in our buildings. Safe and healthy workplaces, very important. Air quality and so on are important as well. And associated with all of that is active capital management to make sure that we are looking at sensibly building out our enhancements, being flexible with regard to the structures that we look at for our leases. So, not headline rent, but if we can get good leases with lower capex associated with them, that's of course something we do. And of course, we are continuing to monitor the bank and debt markets and the rate environment to assess optimal timeframes to look at either hedging additional debt or additional parts of our debt, I should say, and for looking for the right windows to refinance our debt that's upcoming. With that, I will pause in case there are questions.
Okay, looks like there's no questions this evening.
Okay.
Yeah. In case you have any closing remarks, otherwise, I think.
Oh, thank you. I've kind of I think where we are right now is obviously very interesting times for US real estate. We are doing everything we can at an asset level to get the best outcomes from a leasing and therefore visibility of cash flow standpoint. I'm going to be personally in the US for a few weeks, starting next week, where I'll be looking and spending amount of time looking at a number of our properties and getting a feel for the ground and to assess whether and how our strategies are working and what more we need to do to make sure we get the best outcome for our assets and therefore the REIT and for our unit holders. So stay tuned. Thank you. With that, Nigel, I shall sign out.
Yeah. Yes.
Thank you.
Thank you.